All right, let's get started. It's August 14th, 2020. Welcome to Marsh Captive Solutions session number 6, 2020, where we have 20 minutes of relevant captive content, 20 past the hour, all through 2020. Today, I am delighted to be joined by two panelists, Michael Rouse, U.S. Property Practice Leader, and Sarah Downey, D&O Product Leader. We're going to talk all about the hard market, what's going on with captives, what's going on with the market, and then we'll talk a little bit about what's to come in the future. So thanks for joining us today. So Mike, maybe I'll turn it over to you to give us a little bit of a property market update, and then we'll get into how captives are responding to the hard market in the property sector.
Thanks, Mike. Appreciate the opportunity to address the group. I hope everyone's doing well and staying healthy during this crazy time. Mike asked me to give an update on the overall property market. I'm going to try and do this pretty quickly. So I'll, if there's questions or whatnot afterwards, more than happy to address them. But overall, from a market standpoint, the property market now through Q2, we've seen 11 straight quarters of positive rate increases. That's on the heels of what was a soft market that lasted for about 16 quarters. In Q2, the average rate increase on our portfolio is 21.5%. You'll see that in the chart on the top right part of the screen. For larger clients, so when we look at our premium volume, $1 million in premium or greater, as well as shared and layered programs, certainly Q2 outpaced prior quarters and outpaced our average portfolio with the almost 28.5% average rate increase. And so that's a blended rate across our portfolio in Q2. Just for a data point, if I look back over to kind of the peak of 2014, which is just prior to our 16 straight quarters of negative rates, right now our portfolio for that same like-for-like group of clients in the first half of 2020, the rates are up by about 24% year on year. So it starts to make us think, okay, what's the sustainability of this market? Where are we going? How much further do we have at this current rate environment, with Q2 obviously being kind of the high water mark? Lots of things, I'd say beginning of the year, we probably would have walked our way out of this tough market in Q3 and into Q4. But unfortunately, with the events of COVID-19, it's kind of changed the market. A lot of uncertainty around losses from a carrier perspective. We've seen, in Q2 earnings calls, some significant reserve increasing associated with COVID. We've also seen a lot of struggles with respects to either quantifying losses, obtaining coverage, and/or initial claim payments. Q2 was just in and of itself rather difficult, just from a per risk, from a couple of cat losses. Specifically, the big ones from a property standpoint were the convective storm losses in Nashville, as well as in South Carolina and up in Illinois, as well as the tragic and unfortunate civil commotion losses that we experienced in the U.S. in May. Mid-year reinsurance renewals were definitely probably tougher than they've been in the past, certainly worse than the January ones, according to Guy Carpenter. We did see a consistent uptick in rate. More importantly was probably a scrutiny around exclusionary language, communicable disease being the most notable, along with non-physical damage, cyber. We'll continue to kind of watch the market at the moment. Hurricane season absolutely is going to play a big impact. There's a pretty aggressive forecast for the balance of hurricane season, so we'll see if it plays out, as we've got a storm obviously brewing right now in the Atlantic. Another thing that I think, just when I think about the sustainability of this market that comes into play, is just how property books are going to perform. We're continuing to hear from property markets that while they're getting the rate, they're struggling from a profitability standpoint. It's very subjective depending on the market, oftentimes really just driven by some per risk issues, as well as who was or was not providing some element affirmative communicable disease. So really kind of just tracking that, I think that'll have an impact as to where we go in the market from a 2021 perspective. One thing we did see in Q2 that was not reflected in the prior quarters to the same degree was just a greater scrutiny around terms and conditions, non-physical damage BI being really the most critical, along with communicable disease. It's pretty consistent across the board at the moment of absolute exclusions within the property insurance marketplace. And so we're continuing to think about different options for our clients associated for solving for that risk, as well as riots and civil commotion. A little bit more capacity in the market associated with that, but depending on the industry, retail is probably the most notable where we've seen a greater flow of exclusions for that cover. But there's a standalone terrorism market. In some instances, we've used some standalone terrorism from the London marketplace to gap fill where there was a potential gap in coverage. The biggest question, how long is this going to last? And so as I kind of mentioned before, I think into 2021, I'm kind of bullish on the market. I do think depending on how the balance of the year plays out from a CAT standpoint, from a pricing perspective, we'll start to see the market level out, not necessarily flatten, but maybe get back down into single-digit type rate increases. Just on our 7/1 business and 8/1 business, we did see markets start to walk back some of their initial rate increases. So that's a positive sign. There's some good signs about capital coming into the marketplace and startups towards the end of the year. But I do think it'll be a bifurcated market. I think some of the softer occupancies will probably see the benefit initially. We still have our challenged industry groups, whether it's forest products, heavy industry, mining, metals, and food manufacturing, where there's still just a void of capacity in the marketplace at the moment. So thinking about a captive, to me, clients, that's your biggest leverage against the market at the moment. Mike, if we jump onto the next slide, several different ways that a captive owner can utilize a captive to help create capacity, generate competition against the marketplace, build up supply, and ultimately help to mitigate some of the pricing increases and or term changes within the market.
Great. Thank you so much, Mike, for those insights. There's literally not a day that goes by, especially in the last 6 months, that we haven't had an inquiry from virtually all industries, public, private, about property and how they can use a captive, how they can use their existing captive. Marsh has had a tremendous amount of new captives being formed. Many of those are for casualty lines of coverage, but many of those are for property. So just to give you a statistic, for the first half of 2020, we had a 127% increase in the number of captive entities that were formed as compared to the first half of 2019. So that just shows you that captives are doing everything that you see on this screen. They are doing retentions. We're seeing clients forced into higher retentions. We're seeing clients doing fronted reinsurance, plugging and playing in different layers. And that's one of the huge negotiating leverages that you have with a captive. Companies that already have captives are doing excess, are doing quota share. So there's really no part of the property program and part of the property placement renewal strategy that can't sort of lend itself into a captive strategy. And Mike, I know that we've talked about this a lot. Are you even seeing captives participate in TRIA as we've seen over the last few years in your perspective, Mike?
Yeah, absolutely, Mike. Obviously, last year around TRIA, there's a little bit of uncertainty. Fortunately, our federal government passed the law. We didn't have a gap or have to worry about sunsetting, which was unbelievable. But so continued use of TRIA captives without a doubt. Mike, when I think about how to use a captive, you're thinking like an insurance carrier, right? And if I think about a client's risk, where's the most positive part of the risk, right? What am I most comfortable with? Is the construction of my assets in California, as an example, do I have new assets there? Could I maybe say, hey, you know what, let me retain my California earthquake. It's a better part of my risk. Let me transfer the things that show more volatility or perhaps are not as high quality. Let me transfer that to the marketplace. Also, the retention side of things around deductibles, Mike, is spot on. As a market, one of the biggest drivers in the market has been attritional losses over the last 3 years. And so we've seen clients use their captive, put better loss control plans in place, fully fund that retention, and then administer it through the captive with a lower upfront deductible. And then obviously aggregating that limit and having the third-party carriers sit excess of it. So it's really been a good solution to kind of, one, potentially, as opposed to paying premium to the market, maybe retain the profitability associated with that if we can mitigate some of the losses, and then obviously drive competition to get more people attracted towards the risk, which would be excess of any historical attritional issues. So, captives are a great tool in this marketplace to drive competition against the marketplace. And quite candidly, the market knows it, right? On those good risks, they know that they see clients buying a little less risk. They see it as a potential threat to their business.
Great, thanks, Mike. So if your CFO or your treasurer is looking at you and trying to save some cost, think about a captive, your existing captive, saving costs, or even setting up a new captive. So thanks so much, Mike. Now we're going to turn it over to the other person on this team that I've been on the phone with probably every other day is Sarah Downey, who's going to give us a little bit of an update on the D&O market from side A, B, and C perspective. Sarah, I'll turn it over to you.
Great, thanks so much, Mike. So as many of you probably already know, the D&O market experienced a soft market for years and years. But in 2018, the market started to transition to where we are today, which is an incredibly challenging market. D&O rates quickly started to increase, and now those increases are quite significant. As you can see, the difference between rate increases from the end of 2018, looking at the slide, 5% for the primary layer and 2.4% for the total program layer, as compared to 27% and 59% respectively in Q2 of this year, is incredibly significant. Carriers began pushing to increase retentions, and we're still seeing that quite often. There have also been capacity reductions. So by that, I mean two things. First, a number of newer or smaller carriers have stopped writing D&O insurance altogether. So there are less D&O markets. And second, carriers have stopped providing larger blocks of limits. So we're not really seeing the $15 or even $20 million limits that limit blocks that we used to see. And for some industry classes, we're not even seeing blocks of 10 or 5 anymore. We're kind of down to 2.5. So that just causes a lot more challenges. And we've also been seeing narrower policy wordings, policies with more exclusions, and carriers are also taking a much stricter position when it comes to claims and claims behavior. So if we move on to the next slide, Mike, I just put this slide in there because as you can see, 99% of our U.S. public company D&O clients experienced total program rate increases in Q2. And 99% to me is mind-boggling. It's such a staggering number. And it also is the first full quarter in which the impact of COVID-19 spans the full quarter. So we're starting to see that play into the D&O market as well. To be clear, the pricing impact is being felt at all layers of the D&O program, including not just the primary, but on the excess layers. And now we're seeing premium increases on the excess side A only layers, where increases have become more common due to the fact that there are several large recent derivative action settlements, and a number of those derivative actions are still pending and are expected to also involve very large settlements. So if we move on to the next slide. So a lot of clients ask us kind of, why is this happening in the D&O space? And there are definitely a number of reasons that, when you combine them all, they create the perfect storm. So some of those include the fact that for the last 3 years in a row, we've had record-breaking numbers of securities class action filings, while at the same time, there has been a decrease in the number of public companies, which means there's a much higher chance for a public company of being sued than there was years ago. There's also an aggressive and relentless plaintiff's bar exploiting any bad news and turning that into a D&O claim, which in part has fueled the increase in filings. Because there were years of soft market pricing and broadening coverage, D&O insurers are now operating in the red and basically are now fighting to survive. There have also been some bad court decisions that have led to an increase in defense costs and settlement values. In addition, there's also been a developing phenomenon, which I just mentioned, basically over the last 5 years or so, where we are seeing an increase in the size of derivative action settlements. The settlements used to not involve any compensatory damages, so there was no real monetary component to those settlements. But this is really important because in most jurisdictions, derivative action settlements are non-indemnifiable. And that's where Side A coverage under a D&O policy really comes in. Side A is the only form of risk transfer for these types of settlements because, again, Side A settlements tend to be non-indemnifiable. So in other words, because the settlements are non-indemnifiable, a company cannot pay these settlements on behalf of the directors or officers who are named as defendants. So the settlements either need to be paid for by Side A insurance or the individual directors and officers have to pay out of pocket. And then, of course, we have COVID-19, which is, as Mike mentioned before, with property has definitely added to the challenges. Not only have there been a number of COVID-19 related D&O suits that have already been filed, but just the general uncertainty around the impact of the virus, the global reach of the virus, and, as outlined on the slide, a number of other factors have also caused even more pressure on D&O rates. And I wish I could be as optimistic as Mike when it came to property. We don't foresee the D&O market improving very much through the rest of this year, but time will tell. So Mike, that was kind of it for the D&O market update and kind of how we got to where we are today.
Thank you so much. It's property and it's D&O that are the constant pain points of organizations. So Sarah, maybe talk to us a little bit about the most typical structures you've seen with captives from a D&O perspective, and just maybe talk a little bit about this slide that's on the screen now.
Yeah, sure. So Mike, to your point, last year we probably had a handful of conversations about putting D&O on captives, whereas this year we have a handful of conversations every week with different clients about putting D&O in a captive, whether it's an existing captive, forming a new standalone captive, or even using a protected cell through a third-party captive. At this point, what we are seeing more of is we are seeing pre-existing captives bring the D&O into the captive for Side B and C coverage. Now, Side C coverage is coverage for the entity itself, where the entity is alleged to have done something wrong, and Side B coverage, we call it reimbursement coverage, is where the company indemnifies or reimburses the directors and officers for their defense costs or, cost of a settlement or judgment. So most often we are seeing the B and C side coverages being put into a captive. As far as structure, we're seeing different things, whether it's in the form of a retention or whether the captive takes the primary layer. We're not really seeing, unless Mike disagrees, we're not really seeing that many captives take like the excess layers on the D&O program, because the reason you would bring, or a big part of the reason you put your D&O in a captive is to save money, and the most expensive layers are still the primary layer or the lower layer level excess insurers.
Great. Thanks, Sarah. And so we've all presented it to the board and about different topics and issues, and whether you're a treasurer, a CFO, CEO, et cetera. What are the actual directors and the officers of these organizations concerned with when we talk about D&O insurance, that they're to protect them? What are you seeing there, Sarah?
Yeah, I think there's, directors and officers are incredibly concerned at this point. First of all, because just the price of D&O has gone up so much. But then when you factor in how Side A pricing has started to become more challenging, that is their last line of defense. Obviously, a director or officer would never want to pay out of pocket. They don't want their personal assets to be impacted. So Side A is their largest concern. And, when it comes to talking and having these conversations about putting D&O into a captive, the concerns really become very visible when it comes to the Side A discussion, because for the most part, putting Side A in a captive has been done. It's somewhat untested, but directors and officers are concerned over a few things with putting Side A coverage into a captive. First, if their company were to become insolvent, would a bankruptcy trustee or creditor be able to access that money? And therefore, the directors and officers would lose that Side A coverage in the captive. Another issue is whether or not a court might uphold or object to the use of a captive to fund something that should be non-indemnifiable, where the money in the captive actually does come from the company itself. So those are really the concerns these days when we do talk to directors and officers about D&O and just the potential use of captives.
Great, thanks, Sarah. So with 4 months left to go in this year, hard to believe, and your predictions into next year for D&O and Side A and captives. Any parting thoughts?
Yeah, I mean, again, we've been having so many more conversations this year about the use of captives for D&O. That's going to continue to increase. We've seen more of our clients put their BC side coverage into standalone captives. We have also seen a handful of clients actually use a protected cell through a third-party captive to put their Side A in there. And again, it's untested, and the question comes down to really if the board is comfortable taking the risk of putting the Side A into protected cell captive. But I suspect we're going to continue to see even more companies start to put their BC coverage into a captive, and I think we'll also see more companies put their Side A coverage likely into protected cell captive.
Great, thanks, Sarah. So a protected cell captive does give you that, opportunity to fund your Side A should you decide to. And I've had a tremendous amount of conversations about this because it's walled off, it's separate, it's statutorily protected. So if you're thinking about Side A and you're thinking about a captive, let's have that conversation and let's potentially put a rent-a-cell opportunity on the table. So thank you so much, Michael. Thank you so much, Sarah. We are almost out of time, but again, your questions and feedback are always appreciated. We will be sending these slides out to the participants. Any questions, reach out to myself. My email is on the screen. It'll be in the slides. If you're interested in hearing about any other topics this year, with again 4 months to go in the year, please let us know. We want to know what you're thinking about. We want to react to that. We want to bring you relevant content in 2020. And just a quick reminder, September 17th will be when the Marsh Captive Annual Benchmarking Report comes out, and we're going to have a dedicated 2020 webinar just to that release. So thank you. Happy Friday. Enjoy your weekend. And thanks for joining.